Thanks for joining us for our weekly investment audio cast, Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So we'll go ahead and start with our chart of the week, and we labeled this one Trees Don't Grow to the Sky. And the table here, it shows the top 10 stocks in the S&P 500 in 5-year increments starting in 1980. And it's fascinating to see how the composition has changed over time. IBM had a terrific run from 1980 through 1990, but fell out of the top 10 entirely by 1995. GE had a similar run from 95 through 2005, but then fell in its rankings. And by 2020 or so, it wasn't even in the list anymore at all. Apple, Microsoft, and Amazon are some examples of companies that have now gone on a similar run of success. History suggests that new themes and companies will captivate the market's attention in the next 10 to 20 years. And this table emphasizes that leadership changes and investors, they really need to be flexible and forward-looking when they're thinking about how leadership can evolve. Now, on to the market action so far in 2025. Last week was a solid week. The S&P 500 returned over 4%. Small cap stocks did as well. International stocks returned about 3%. And for the year, domestic large caps are still down 5.7%, but that's an improvement. And small caps are down about 11.9%. Now, developed international markets are up 10.1%, and emerging market stocks are up 2.9%. And we continue to believe that a theme of this year should be geographic diversification. That really makes sense to us. Now, a little more on the rally attempt from last week. There were some positive developments from an indicator perspective. Here we're showing a 3-day price thrust indicator. It gives a bullish signal when the S&P 500 rises 1.5% one day and at least 1.15% the next day and at least 1.5% on a third day. So 3 consecutive strong days in a row. And we can see here that since 1970, it's been fairly rare. There have only been 14 occurrences, and the market has gone on to rally over the next 12 months all 14 times for an average gain of 22%. Of course, we want to see more technical confirmation, but indicators like this are a really good start to the market recovery from this year's correction. And for now, the technical picture is improving amid a backdrop of still depressed sentiment. This chart combines a number of sentiment indicators to form one composite reading. It shows that sentiment is still pessimistic, which historically has been consistent with contrarian market rallies. Now, from an economic perspective, the hard data like retail sales or durable goods orders, that still looks solid, but not spectacular. The issue is more in the soft survey data, like the purchasing managers indices. Here we're showing the composite PMI blue in the top clip. It's slowed this year and is now at the lowest level in about a year and a half. The weakness was led by a drop in the service sector PMI shown in light blue in the bottom clip. Now, some of this weakness appears to be a reduction in tourism from international travelers into the US. Now, a potential issue here for the Fed and their monetary policy stance is the reported rise in pricing in the PMI survey from last week. In the bottom clip in orange, we can see that prices for manufacturing companies rose at their fastest level since the 2022 inflation surge. The top clip in dark blue shows that reported PMI prices tend to lead actual realized inflation, which is the dashed orange line, by about 3 months. Now, the degree to which companies can pass higher prices on to consumers will matter for profit margins and earnings. But looking at the first quarter earnings, we can see that companies appear to have been in very good shape. So far, 179 S&P 500 companies have reported, and earnings growth has come in around 19%. And that's been led by a surge in healthcare and communications earnings. Now, expectations are for about 10% growth once all 500 companies have reported, which would be a second consecutive quarter of double-digit earnings growth. Now, a strong earnings backdrop is even more important because valuations do remain elevated. This chart shows three different price to earnings ratios. The top clip in dark blue is using the PE, using forward expected earnings. The middle clip in orange compares the market price to operating earnings, which can be manipulated quite a bit by management. Now, the light blue bottom clip is the price to reported GAAP earnings. In all three, the valuation remains above its historical average. Now, we showed this chart a few weeks ago to help lay out where we think we are in the correction process. Historically, correction lows follow a four-step process. The blue line is a stylized representation of market prices. The orange line is a stylized representation of the percentage of stocks making new lows. We currently think that we're in phase two. That is where the market is making a strong rally attempt and market breadth is improving. But we still expect that a retest phase could be ahead of us. So while last week was a strong week and a good start, we still expect elevated volatility in the upcoming weeks or months. So, our closing thoughts from this week: the composition of the top 10 stocks is constantly evolving. We should be flexible and forward looking. Last week was a solid rally attempt and a good start in a resumption of the bull market. From an economic perspective, survey data like the purchasing managers indices are still weakening. But when we look at hard data and earnings, companies and consumers appeared to be in good shape in the first quarter. A clearing of uncertainty could be helpful for future economic activity. As for where we think we are in the cycle, we think the market is in phase two of a four-step bottoming process, but expect elevated volatility in the upcoming weeks or months. As always, thanks for joining us today and have a great week ahead.